Welcome back. In the second module, we looked at the individual tax formula. We looked at income from all sources, and we looked at allowable deductions. We also looked at certain provisions in the tax code that promote taxpayer behavior, such as the provisions related to purchasing a house, making investment decisions, and making retirement decisions. For this last module of the course, we're going to turn to business decisions, and we're going to focus on the most common business decisions you would need to make as an entrepreneur, since the focus of this course is individual taxation. This chapter, Chapter 6, looks at taxable income from business operations and covers how certain accounting assumptions get addressed in the tax code. Assumptions related to gross income and taxable income, calendar year and taxable year, and accounting method. As in personal income taxes, taxable income for a business or an entrepreneurship is equal to gross income minus any allowable deductions. Also, as in personal income taxation, gross income refers to income from whatever source derived. This is broad enough to capture investment income, royalties from intellectual property, rents received from real estate, as well as normal revenues from the course and scope of business. Deductions refer to all ordinary and necessary expenses paid or incurred. And by ordinary business expenses, the tax code means expenses that are customary for the particular trade or business and are frequently incurred. The tax code defines necessary business expenses as expenses that are appropriate and helpful for the development of business and generation of revenue. And we'll look a little bit more at that in a second. So, in order to be a deductible item for tax purposes, it must be frequently occurring and necessary for the business. Certain items, though they may be ordinary and necessary, are excluded from taxable income or deductions because of certain provisions in the tax code. These include political contributions, illegal kickbacks, bribes, and fines and penalties. The tax code excludes these items, even though they may occur in the normal course and scope of business, because it doesn't want to subsidize illegal or questionable activity. It also doesn't want to subsidize political activity. Just like interest received on municipal bonds is excludable from taxable income, any interest expense associated with purchasing municipal bonds can't be deducted for tax purposes. The tax code also limits business entertainment and meal expenses. Business meal deductions are only allowed to be deducted at 50%, and entertainment expenses are not deductible. The tax code also gives preference to certain items. One of the ones the textbook talks about is proceeds from life insurance. When a key executive passes away, the proceeds from life insurance are not included in corporate revenue. Accordingly, any expenses made to purchase a life insurance policy on the key executives is not a deductible expense. So let's test your comprehension. Is the expense deductible? And we're going to look at a small business in Lubbock selling cookies and custom baked goods. So a $1,600 annual maintenance expense on the commercial mixer, ovens, and freezer. Is it deductible? The answer is yes, because these maintenance expenses are ordinary. They're what you would expect of the business and its industry, and they occur on a regular basis. Item 2. During busy months, during the Christmas rush, during the Valentine's Day rush, and during the graduation rush, the bakery buys dinner for any employees who are still working after 8 p.m. The total for these meals were $800 for the year. Is it deductible? The answer is partially. Recall that the tax code limits meal expenses deductibility to 50%. The $500 annual life insurance premium for the CEO, is it deductible? The answer is no. However, if the CEO were to pass away unexpectedly, the revenue collected from the policy would not be includable in income expense or in income. Finally, $300 for quarterly pest control treatments. Would it be deductible? The answer is yes. And again, it's an ordinary expense, it's a frequently occurring expense, and maintaining a clean workspace is a requirement of the baking industry. Another choice that a business must make in the course and scope of performing their operations is what time period in which they should record income. We pay taxes on an annual basis, and the taxable year generally correlates with the 365-day period used for accounting purposes. Businesses that use a calendar year record income, open the books, that is, on January 1st, and close the books on December 31st of the given calendar year. Businesses that use a fiscal year use a 12-month period beginning and ending on any date other than December 31st. Businesses that elect a fiscal year generally do so to align with their operating cycle. For instance, many retail businesses close their fiscal year on January 31st to account for their busy season, the Christmas retail season. Now let's look at what calendar year and fiscal year means by examining a local bakery here in Lubbock. Sugarista opens its doors for business on March 16th of 2019. Since the business is organized as a proprietorship, the owner files business taxes on a Schedule C as part of her personal taxes. Since she reports her personal income on a calendar year basis from January 1st to December 31st, the tax year for Sugarista is then January 1st through December 31st, also a calendar year basis business. And the first year in which she does business is actually shorter than 365 days because she began recording income on March 16th of 2019 and she closed her books on December 31st of 2019. For subsequent fiscal years, she'll report on that calendar basis. But now let's assume that after a few years of operation, that Sugarista's owner decides that a June 30th fiscal year end actually fits better with her operating cycle because it allows her to get through the different busy seasons of the year. Valentine's Day in February, graduation season in May, and the Christmas cookie season in December. What can she do? If she's still reporting as a proprietorship, nothing. She still will continue to report business income during the calendar year so that it aligns with her personal income tax return. However, if the business has incorporated, she can petition the IRS for a change, presenting compelling reasons for changing her fiscal year. Once the IRS has approved the tax year change, she would file a short year return from January 1st of whatever year she changes to June 30th of whatever year she changes. So that way, her books will be on cycle again. The IRS allows for 3 methods of accounting. By method of accounting, I mean the recognition of income and the payment of expenses for tax purposes. The cash basis businesses record income when it's received, not necessarily when it's earned, and it records expenses when they're paid, not necessarily when they're incurred. An accrual basis business is what you would have learned in your financial accounting class. They record income when it's earned, but not received, and they record expenses when they're incurred and not paid. A hybrid business will borrow elements of both, and there are certain income and expense items that must be spread out over a longer period of time. We'll talk about these in a minute. Under the cash method of accounting, income is generally recorded when cash is received, not earned, and expenses are recorded when paid, not incurred. For the IRS's purpose, income is received when a person has access to and control of the income, even if it is not in the person's possession. As an example of that, interest that you receive on your savings account is yours as soon as the bank posts it to your account. It doesn't have to be cashed out or withdrawn for it to constitute income. Likewise, when a client pays you for services rendered, you've received the payment when the check is in hand, not necessarily when you deposit the check. However, even under the cash method of accounting, there are certain expenses that must be recorded and capitalized over a longer period of time. Prepaid expenses with a useful life of more than 1 year must be capitalized over their lifetime. Prepaid interest must also be capitalized and deducted in the year or years in which the interest is actually charged. And for businesses that hold inventories and sell merchandise, they must use a hybrid basis method, as they must capitalize the costs associated with inventory holdings and managing inventories. So let's take a look at Sugarista and some of the routine income and expense items that she would receive as a cookie business. If, as a small business, she's using the cash method of accounting and uses a calendar year for reporting income, which transactions will be recorded as taxable income or allowable expenses for the current year? If Sugarista paid her business insurance on March 16th of 2019, and the policy covers her business until March of 2021, so this is a transaction that has a lifetime greater than 1 year. So Sugarista would have to split this across 2 years, deducting half of it for 2019 and half of it for 2020 until 2021. Item 2. A customer paid a $250 deposit for a large order of cookies for wedding favors. The deposit will be applied to the customer's total bill for the February 14th, 2020 wedding. Is it an income item for fiscal year 19, or is it an income item for fiscal year 2020? If Sugarista uses the cash method, this deposit was received in 2019, so therefore it would be applied to her 2019 revenue. When she receives the balance of the payment in 2020, that would be recorded as 2020 revenue. Finally, a $5,000 business loan was received from a local bank on January 15th. The loan is payable in the following year. How much income or expenses would be allowed in fiscal year 19? The answer is none, because the receipt of a business loan creates a liability. It doesn't generate an income event. Any interest expense associated with the loan would be recorded when the loan is paid, not when the loan is created on the books. The pros and cons of cash basis. It's simple and it's objective. You know when the cash is coming in the door, you know when cash is going out the door, and all of your such transactions are recorded and supported by bank records. However, there are some disadvantages. There's a potential to manipulate the system by timing purchases and receipts. That is, for present value purposes, you get a better tax benefit if you can deduct the whole of an expense in a fiscal year rather than in future fiscal years. So this might encourage businesses to shift expenses around to improve their tax position. However, the hybrid and the accrual requirements for these prepaid expenses attempts to prevent that. And finally, a disadvantage is that cash basis accounting cannot be used by large corporations. And by large corporations, we mean a business that has revenue of greater than $25 million. The exception is personal services corporations, but we'll get into that later. In contrast to the cash method of accounting, where expenses are recorded when they're paid and where income is recorded when it's actually received, under the accrual basis of accounting, income is generally recorded when earned, and expenses are generally recorded when incurred, not paid. This method of accounting is prescribed by generally acceptable accounting principles, as well as required by the Securities and Exchange Commission for any business that is publicly traded and holds stock shares. So let's look at the difference between cash basis accounting and accrual basis accounting by going back to our example about Sugarista and the bridal party order. Let's assume instead that the bride paid for the party favors in full in November 1st of 2019 when she placed the order, and that the wedding is scheduled to take place on Valentine's Day of 2020. How much income should Sugarista report if it uses the cash basis for accounting? In fiscal year 2019, Sugarista would record the full $3,000 earned because that's when the cash was received in hand. That's when she received the check from the customer. In fiscal year 2020, when she actually delivered the order, she would not record any additional income. Now, if Sugarista uses the accrual method of accounting, she would record no income in fiscal year 2019 when the bride placed the order. She would record a prepaid asset and then record the correlating income in 2020 when she actually did the work to earn the revenue. The treatment of certain expenses and income items as per generally accepted accounting principles and as per tax principles can create temporary and permanent differences in the amount of income recorded for tax purposes and for accounting purposes. A permanent difference occurs when the income, gain, or expense is never realized on either the accounting financial statements or for tax purposes. For example, tax-exempt interest is never recorded as taxable income, but it is recorded as business income. Fines and penalties are recorded as business income, but they're never deducted from taxable expenses. Temporary differences occur when the income, gain, or expense item is reported in a different year for tax purposes than it is for an accounting purpose. The example that we just looked at for Sugarista, is a temporary book to tax difference because the income item under one method would be generated in one year, whereas it would be reported for tax purposes under the other. These will eventually reverse and even out. A tax asset is created when income for tax purposes is higher than income for accounting purposes. This is undesirable because firms, like individual tax filers, never want to pay more taxes than they're absolutely required. A tax liability is created when income for accounting purposes is higher than income for tax purposes. This means they know they're going to have to pay taxes on it later, but they get to take advantage of the cash now. For income, the timing definition drives certain temporary book to tax differences. For accounting purposes, all events must have occurred, the amount of income must be reasonably determinable, and you record the transaction as income statement income when you record it to your financial statements. However, for IRS purposes, income is earned when the earnings process is substantially complete or when the taxpayer receives payment, with a few exclusions. Another difference pertains to the treatment of accrued expenses. For accounting purposes, firms must identify any liability for an unpaid expense and accrue for these expenses on the firm's financial statements. For IRS purposes, you only can deduct the expense once it meets the all events test. That is, all events establishing the liability must have occurred, the amount of liability can be reasonably determined, and economic performance has occurred. Economic performance is defined as the time period in which the services, property, or use of property has taken place. There's a few exclusions to economic performance. For payment liabilities, the deduction can occur when the taxpayer makes the payment to the person to whom the liability is owed, including workers' compensation, payments for tort, breaches of contract and violation of law, liabilities for customer rebates and refunds, liabilities for awards, prizes, and jackpots, and liabilities for taxes imposed by a government authority. This difference is because until you actually make the payment, you don't have a good grasp of what the amount is. It's not reasonably determinable. So therefore, for economic purposes and tax purposes, it's not accruable and it's not deductible until it actually occurred. And this chart shows some examples of book to tax differences. For accounting purposes, you would deduct an employee's compensation in the year of accrual. But for IRS purposes, you can deduct the salary payment in the year that the compensation is paid, unless payment is made within 2.5 months of fiscal year end. For business bad debts, most firms use the allowance method, accruing bad debt expense as an offset to income. For IRS purposes, until you know the actual amount of bad debts, as under the allowance method, you can't deduct them. Firms that use the direct write-off method can write off the expenses or deduct them for tax purposes once they're written off the books. Likewise, when a firm recovers a bad debt, they would record an offset to an allowance for doubtful accounts. For accounting purposes, this would have no impact on the income statement. For IRS purposes, any receipts of debts that have been written off the books through the direct write-off are recorded as income in the year that you can recover it. And finally, net operating loss. For accounting purposes, you can only deduct the amount of the loss that occurs. For IRS purposes, they allow a company to carry forward a net loss to future years, allowing them to offset the loss with future gains. So let's look at the treatment of book income versus tax income for each of these following scenarios. If Tiff's Treats paid $25,000 in legal fees and paid $100,000 to settle a sexual harassment claim, they would deduct $125,000 from their book income. However, since this activity is disallowed for tax purposes, it would have no impact on taxable income. If Tiff was incorporated last year and showed a $21,400 net operating loss in the first year of operations, they would report no income for book purposes. They would report a loss. In fiscal year 19, they would report no income and pay no income tax. However, if they were profitable moving forward, they could then use the loss to offset gains or income in future years. If Board of Directors approved a $15,500 bonus to the CEO or president as of fiscal year 2019, and they paid the bonus on January 12th, this would have a $15,500 deduction from book purposes, as well as a $15,500 deduction for tax purposes. Even though generally salary items are not deductible until they're paid, there's an exception that allows you to deduct the item in the year in which it's accrued if the item was paid within 3.5 months of the accrual. January 12th is well within that 3.5 month period. So the expense can be deducted from current year income. And finally, during the year, Tiff's Treats entered into a 5-year licensing agreement with a franchisee. The franchisee is allowed to use Tiff's name to market its own product. In exchange, the firm will pay Tiff an annual royalty of 1% of gross revenues from sales. The firm paid a $4,000 advance royalty to Tiff on the day of the contract signing. Tiff credited this to an unearned revenue account. For book purposes, Tiff's is not recording any income. This $4,000 advance royalty is credited to an unearned revenue account because it's an advancement on revenues that it has not yet received. However, for tax purposes, this item must be added to income because it's been constructively received, and the economic occurrence that would make it an income item has occurred. So that, therefore, for tax purposes, they must include this $4,000 in income. In this unit, we examined how the tax treatment of accounting year and the tax method impact the tax liabilities, creating book-to-tax differences that can be either permanent or temporary. In the next unit, we'll examine the tax treatment of acquisitions, the tax treatment of depreciation, and the tax treatment of gains and losses on the disposal of assets.